Welcome to Trading Nation. I'm Eric Chemi, joined now by Ed Yardeni, President and Chief Investment Strategist of Yardeni Research. Ed, thanks for joining us here on Trading Nation. How are you doing today?
Just fine, thank you.
All right, so let's go right to it. You coined the term bond vigilantes back in 1983. Tell me, Ed, are the bond vigilantes, are they back?
I think they are back. They've been sort of buried by the central banks. Central bankers have clearly taken over the bond market in recent years since 2008, especially with quantitative easing by purchasing bonds. But they might have been buried, but maybe they're coming back as zombies, you know, the living dead.
Zombies, huh? And just, I know it's basic, but for our viewers who might be a little bit newer,
Yep.
What is a bond vigilante? Just explain that super basic.
Well, the basic concept is that when the bond vigilantes aren't happy with what they're seeing happening with monetary policy, fiscal policies, if they think they're too inflationary, then you'll see bond yields rising in protest, in anticipation that these policies will lead to higher inflation and won't be good for fixed income investors. And that backup in bond yields then in turn can very well have the desired effect on the part of the bond vigilantes, namely slowing the economy down and bringing inflation down. During the 1980s, we had several episodes where the basic trend of the yield was down, but occasionally we'd have these pretty significant backup in bond yields that slowed the economy down and brought inflation back.
When you look forward at your forecast relative to what the Fed is saying, relative to everyone else, do you feel like there's more inflation ahead than people are thinking about, or maybe actually it won't even come through that high?
Well, it seems as though overnight with the election results, there was kind of a widespread perception that with the new administration, we'll have for sure more fiscal stimulus. We might have trade protectionism. We might have fewer workers if immigration is cut back. And all these things are inflationary. So the reality is the economy is actually doing quite well right now. Wage inflation has actually started to pick up, suggesting that we are at full employment. So those wage numbers were already starting to be a concern for the bond vigilantes, even before we had a sort of a regime change, if you will, that might in fact spark more inflation. So I would think what's really changed is very unlikely we're going to be facing deflation or still lower inflation. More likely we'll be looking at inflation moving higher.
Ed, you mentioned the election, you mentioned regime change. What about the stock market? Obviously, we've seen a big rally since the election. Maybe people are believing in this Trump thing. Do you buy this rally? Do you see the valuation where the rest of the market sees it?
Well, you know, these markets are all interrelated, and the stock market basically came up with the same conclusion as the bond market. Bond yields went up following the election results, and within the stock market, the overall market went up. But if you took a closer look, you'd see that utilities and consumer staples, telecom services, the interest rate sensitive stocks performed very poorly. The big move was in growth and cyclical stocks, industrials, healthcare, banks that might be able to look forward to less regulation. So there's a lot of kind of do-si-doing going on in the stock market, where stocks that had relatively poor performance and low PE suddenly are performing very well, and the ones that were interest rate related are doing very poorly.
So then just real quick, if somebody had to just pick one side of bonds versus stocks to actually put their money in, do you feel like it's in equities, or are they actually better off staying with bonds?
Well, I think a diversified portfolio. I'm sorry, I can't give you an either or.
That's too easy, right? Diversified, it's too easy.
I don't think it's. I wish it was that easy these days, but it's not. I think a diversified stock portfolio and a bond portfolio still makes sense. I think tax-exempt investors are confronted with the problem that they might have a lower tax rate. So if they already own some of these tax-exempt securities, they might get penalized for the lower tax rate. I mean, Hillary would have been great for tax-exempt bonds because she was talking about higher tax rates. So I would say diversify as usually is the best case in giving advice.
I think we started our next conversation for next time, which is the fact that lower taxes is bad for parts of your portfolio. So Ed Yardeni, of course, as always, thanks for joining us here from Yardeni Research coming on Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.